I've been a financial advisor now for over 20 years. And one of the biggest concerns people have, and rightfully so, is they're worried about running out of money. And in today's video, I'm going to share with you 7 things that you need to know about to help minimize the likelihood that that happens to you. Let's go for a little walk and let's talk about these. You know, the first one, there's the likelihood of running out of money, and then there's also the challenge of having money but not being able to access it. And frankly, that happens to many more people than running out of money. So the access to money, what typically happens there is the major accounts where the money are held are in one spouse's name or in joint accounts. And what can happen is if one spouse has a health issue or suffers from dementia, ends up in the hospital, there's an emergency. If all the money's in one spouse's name, obviously it can be difficult to get access to that cash. And even in a joint account, you need to know that some banks might freeze those accounts if there's been a medical emergency, if there's been one of the people on the account is no longer able to make a logical decision. So know that that's a risk. And so I think it makes sense to have money in both. And each spouse has enough money, maybe for 6 months or 12 months of living expenses, which would give you the time you need to clear up if there is an issue with the joint account doing that. Also know that a power of attorney, while technically that can last for a long period of time, oftentimes banks will have their own rules that'll say a power of attorney had to be signed in the last 30 days or 60 days or 90 days. And you don't want to be surprised when there is an emergency later. So that's why I want this on your radar screen. So check with your bank, check with your attorney. I should say none of this is financial advice. I don't know your situation. But that's the first one, is just make sure not only that you have sufficient money, but that both spouses have access to money in their name that, if assuming you're married, that can last you 6 or 12 months. And that'll give you the time you need to clean up anything that you might have to do later. Okay, the second thing when it comes to losing money that I think a lot of people don't think enough about is the impact of inflation. If you're lucky enough to have a pension, most pensions outside of the US government are not indexed for inflation. So really thinking through what is this pension, what is this cash flow going to look like several years down the line. Some people have annuities that are going to pay a fixed amount every month. And so really understand what your cash flows are going to look like. Now, fortunately, Social Security is indexed for inflation, so we have that protection. But even with your bank, even with your investment accounts, it's important to look at, let's say you look at your accounts and you say, okay, I can take $50,000 a year out of that account. Well, the question is, can you index that for inflation every year? And oftentimes you can, but you want to look at that and be sure, because even with 3% inflation, in 10 years, you're going to be down 25, 30%. In 20 years, you're going to be down about 50%. And in 30 years, that spending is going to feel like it's decreased by 60%. So in that $50,000 example, in 30 years, that's going to feel like, instead of $50,000, that's going to feel like $20,000 in today's dollars. So it has a big impact. And so how do you protect yourself from that? That's item number 3. And that is looking at your asset allocation, looking at how you're invested, and just making sure that overall your account can beat inflation. We've all heard the power of compounding, that when your savings, give your savings and your investments enough time, and then something magical begins to happen as the account continues to grow, and pretty soon your money's working harder for you than you worked for initially to make that money. But know that compounding cuts both ways. The magic happens when you're beating inflation, but the pain happens if you're not beating inflation. If you're not beating inflation, compounding is working against you. And I don't want to see that happen to you. So one thing to think about, and speak with your own financial advisor on this, but one thing to think about is what really is risk. You know, having money in a FDIC insured account at the bank feels risk-free, feels like the safest option. But if risk is, what's the likelihood of me not achieving my financial goal over 7, 10, 15 years? Then the answer to that is very different, right? Because for the most part, FDIC insured bank accounts are going to deliver a yield below inflation or fairly close to inflation. So having money, that warm and cozy money in the bank, might be one of your riskiest options when you look at it over a different time horizon. Okay, let's keep going. Let's look at the next one. And that is another risk for running out of money is your longevity, right? How long are you going to live? And obviously none of us know that. So, you know, while the average life expectancy in the United States when somebody's born is 78 years old, if you make it to 65 years old, the life expectancy of a male 65-year-old, depending on your health, is, you know, early 80s, 82, 83. For a woman, it's a little bit more than that, 84 to 86. But for a couple, believe it or not, there's a 50% chance if both spouses are 65, there's a 50% chance that one of them is going to make it to 90. So another risk that retirees have that could cause them to run out of money is longevity. And so what do you do to protect yourself from longevity? Well, there's a couple things that you can do. Probably the simplest one, and what most people do, is to the extent you can hold off Social Security until you're 70, that's going to maximize your payment along the way. And of course, Social Security lasts us for life. So at your full retirement age, which if you're not taking Social Security now, your full retirement age is likely 67 years old. For every year you postpone, you get an extra 8% a year. So if you wait till 70, that's 124% of your full retirement age. So one of the things you can do, the simplest thing to do, is Social Security and just hold off on that. Another thing that you can do, they do make annuities that only kick in at a certain age. I'm not licensed to sell annuities. I don't want to be licensed to sell annuities, but I do want it to be on your radar screen. So that's another thing that you can think about. And then, of course, the asset allocation can be helpful for that as well. Just your investments and planning for a long time horizon. You know, oftentimes people think, okay, now I've retired and I need to dial back significantly my risk. And, you know, you need to make that decision for yourself. But keep in mind that, you know, if you're healthy, if your family history is such that you think you have a shot at making it to 90, you know, once you're 65, it's not unusual, if you're married again, a 50-50 chance that one of you are going to make it to 90. So keep that in mind when you're looking at your asset allocation. Okay, another thing that can cause people to run out of money and spend more money than they think, and actually this can be one of your largest expenses that few people think about, is taxes. Looking at your tax situation and thinking, how do you take money out of your accounts in the most tax efficient manner? And for most people, this can save thousands of dollars, right? Many people have three basic types of accounts. We have let's say a regular IRA or a regular 401k, which is going to be taxable income when we take the money out. Then we have what I call a tax me never account. You didn't get a tax break on it, but when you put the money in, but that's the Roth IRA and the Roth 401k. You can take that money out, assuming that you're meeting all the conditions, without incurring any taxes on that, any federal taxes on that. And then you have your regular bank account, which I call a tax me as I go. And balancing which account you're pulling money from is an important exercise to do. And like I said, work with an accountant, work with a financial advisor that's a fiduciary for you, because it can save thousands of dollars. So you want to know what that is. Okay, the next one, and people are surprised by this, but the next one is spending more money than you thought you were going to spend. So if you go to a financial advisor and you say, hey, you know, out of my investment accounts, I need to take $5,000 a month. And in addition to that, between you and your spouse, you're going to get $4,000 a month. So in aggregate, you're taking out $9,000 a month. And the financial advisor does the plan. If you end up spending regularly $10,000 a month, an extra $1,000, an extra $1,500 every month, it's important to go back to your financial advisor and let him or her know that, so that you can plan while you still have lots of time in front of you. Financial plans are very sensitive to how much we're spending every month. So while one plan at $9,000 could work out fine, spending $10,000 a month, spending $10,500, $11,000 a month, that could have a meaningful impact. So be sure to talk to your financial advisor. And then one of the biggest risks is what I call sequence of return risk, which is unfortunately getting unlucky in your early years of retirement. And this is one of the main drivers why people end up having to throttle back, end up having to make modifications later in their life to avoid running out of money, is if you get unlucky in the early years when your assets are the highest. If the market is down 2, 3, 4, 5 years, unfortunately, that's when you have the most money. So a negative 20%, a negative 10, a negative 30% type of return impacts that entire base. So it's called sequence of return, and it's really just getting unlucky in the first, let's say, 5 to 10 years of your retirement. So just keep that on your radar screen. None of us know what the stock market's going to do when we first retire. But if you do find yourself in a negative stock market return, that is a time to revisit with your financial advisor and say, okay, what do we do given this? And speaking of what do we do given this, there's some things I want you to think about stop doing in your 50s and 60s as you approach retirement. And that's what this video is, because it's critically important that we enjoy the journey. And hopefully this video will help you think about enjoying the journey until you get to retire. 7 things to stop doing in your 50s and 60s in order to enjoy the journey more. I'll see you in that video. Thanks for watching this one. Bye-bye.